that hopefully we can use not only for you folks that are trying to transition over to become a little more confident with TradingView to recognize these trades, but hopefully also for new people as they come to the funding company and they're like, wow, you know what? I need a plan. So we're going to try and cover all of that for you today. And I'm making this separate video so that we have that good core. And the instructions from the Next Gen Pro Trader Funding, guys, it takes you over to all the indicators that you're going to get. Yeah, and guys, thank Claire for this. Claire inspired this for me. I'm telling you guys, if you tell me what you need, I'll do everything in my power to make it happen. So that's what we're doing right now. I'm going to scroll down a little bit, and it goes through all of how to get your indicators, all that sort of stuff in the beginning. There are descriptions of all of this where you can get all of the workspaces, guys. I'm going to give you in the room right now. So this is the TradingView plan. And this TradingView plan, it is available on the website. And this TradingView plan, what it is it's going through, whoops, open up. It talks about what you're going to use and how you're going to use it. So we are going to use two different time frames, the same way we do with a NinjaTrader. There's going to be a 15-minute chart, and the 15-minute chart guide, this is your roadmap for key targets. This is turning points, terminations. The trigger lines on this chart will define the direction and overall momentum of the market. And when both trigger lines are in the same direction, that's the absolute best. And then the 1 minute, it's going to have market flow on it as long as you have premium. And this is going to define the immediate strength of the market. This is going to let you know what the market is doing right now in the moment. So we're going to take entries from mid bands, HVA lines, one-to-ones. The plan includes a checklist for entries for the trend trade, the HVA trade, and the momentum trade. We're going to talk about all of those. Good morning, 10K. It's great to see you. So the plan is available on the website. I've already dropped it in the room for you. So what we're going to do right now is I've created a little slideshow, and we're going to talk about just the indicators that we're using. And I'm going to do my best to not relate these back to those of you that have experience with the software. I'm going to try and do these as a brand new introduction. So guys, there are going to be small triggers on both charts. The small triggers are going to be the thinner of the two, and they move pretty fast. And there's also going to be large triggers, and the large triggers are going to be bigger and they're going to be slower. We're going to use these trigger lines to define momentum. They are going to let you know when the market is moving quickly in the direction of the trend. And they're also going to serve as a patience piece as you look for trend trades, always making sure that you're on the correct side of these triggers. So we're going to use them a couple different ways, but all you need to know really is the name. There's the small triggers and the large triggers. You're going to see divergence, and divergence is a loss of momentum, and you'll see it print as a magenta line from a pivot at a high or a cyan line at a pivot at a low. And what divergence lets you know is that there was a loss of momentum in the market. So if the market was pushing down and the pivot forms and momentum is lost, you'll see a cyan line. And very often these lines become bounce points. They become areas of interest. And if the market returns back to a divergence low, sometimes that divergence low can stop it cold. If it returns back to a divergence high, it can do the same thing. But it creates an awareness of where the market has turned and that there was a loss of momentum. So every time you see divergence, I want you to think loss of momentum. You're going to see one-to-ones, these yellow dots and these pink dots, and these are 100% Fibonacci alternates. They can be support. They can be resistance depending on the movement of the market. Your yellow one-to-ones are what we call large swing one-to-ones, and they're a 100% Fibonacci alternate, and they're taking from bigger moves, the bigger moves that the market does. The pink one-to-ones, these are small swing one-to-ones, and these are taken from the moves within the moves. The yellow ones are typically going to be a little more important on the smaller charts, a little more effective on the smaller charts. The pink ones will definitely come into play as well in the higher time frames. And just know that if the market is trending up, these are areas that could stop it. And if the market is trending down, once again, these are areas that could stop it. Then next, we have the mid band, which is it's an EMA. It's a exponential moving average, and it runs through the center of your chart. When price is above the mid band will be green. If the rules are met, it may behave as support. If the mid band is magenta, it means that price is trading below it. We're going to use the mid band to take trend trades on the 1 minute chart. You'll also recognize it as a place for a potential continuation if the market is trending on the large chart. And then you will have these outer bands, and these are new for a lot of people. It's a Bollinger Band, I believe. And these outer bands are essentially points of exhaustion. When the trend is moving and everything is going, very often you'll see it reach these outer bands, and it becomes a decision-making point. And perhaps the market may bounce or spike or take a turn the other direction. So when you're using these outer bands on a smaller, faster 1 minute chart, very often they become great profit taking. And if the large chart gets to them very often, that move is pretty exhausted. But you'll be able to see them, recognize them, they'll be in play the whole time. And then finally, zones. If you look at the trading plan, the support and zones using this plan, there's a lot of different companies that offer free versions. John Novak has done extensive testing with most of them and has concluded that Chart Prime produces the most effective areas of support and resistance, guys. So the zones complete the workspace, very often trading to them, trading from them as support and resistance. And as I said, Chart Prime, they give you a free a free trial. You can go in, you can put them on there. But the workspaces are designed to work in conjunction with them. There are opportunities to get free indicators should you look for them. But that is essentially what you're going to look at every time you open a workspace. I'm going to go back to it. You're going to see trigger lines. This is the entire workspace right now. You're going to see trigger lines. You're going to see one-to-ones. You're going to see zones, mid bands, outer bands. And then what we're going to do is we're going to introduce you to 3 trades, 3 ways to capitalize using these indicators. So I'm going to go to my next slideshow. And we're going to talk about the 3 trades that are in the plan. There is a trend trade, there is a high volume area trade, and we'll talk about what that high volume area is. And then there is a momentum based trade. So when we're talking about, let's get a laser printer, that's more fun. Of course, everything's in the instructions, guys. I can't stress this enough. Everything that I'm providing you right now is available on the website. That's where all of the answers come from, but I want to share them with you. Guys, of course, ask questions. I don't want this to be a lecture if there's something that you need help. The first trade that we're going to use is a high volume area trade, guys. This is an opportunity for you to catch tops and bottoms is the easiest way to say it, to get in closest to a top or a bottom. High volume area trades are nothing new. This is a picture from probably 10 years ago. When a key area holds, there's an opportunity to sell it at one of these magenta high volume area lines if Fibonacci support holds. There's an opportunity to get in closer to that fib, and you'll see it through these high volume area lines. So what we're going to look at is we're going to let the market reach one of those zones on a large chart. We're going to let it reach support or resistance. You're going to let it reach yellow one-to-ones. You're going to let it reach divergence lines. And when price reaches these areas, you're going to go to your small chart, the 1 minute chart. And the 1 minute chart is going to show you change that you can't see on that big slow chart. It's going to show you triggers rolling. And then we're going to buy or sell a pullback. So what happens is first an area is reached. So price trades down and reaches a zone. Price trades up, reaches yellow or reaches one-to-ones and a zone. So this is rule number 1, making sure that the market has reached one of these key areas. Rule number 2, on your 1 minute chart. The large chart's already done its job. On the 1 minute chart, You want to see those smaller, faster triggers roll, and you want to see them heading down. You want to see them taking a turn towards the direction that you want to be going. And what this is a faster chart showing you that the market is in fact making that change off of a higher time frame. And then finally, you're going to see what's called a high volume area line. Sometimes it'll form, sometimes it won't, but you need it for entry. So if you see a magenta line printing after the zone has been reached, after the trigger's rolled, what this magenta line is, and you'll see it on the market flow on that 1 minute chart, is this is a visual representation of the price where there were the highest concentration of sellers coming off of that key area. And this price, or this line, extends out to the right. And what it's saying is that all the sellers, the majority of the sellers, got together right at this price. And that's what really started shoving things down from that termination, from that zone on a large chart. And very often it behaves as a line in the sand. So if the buyers come back and try to test it, it is guns a-blazing. And that's typically the first point of continuation off of a zone. So the HVA trade is going to allow you to capitalize. 15-minute zones reached, that divergence high. The small triggers roll. This white bar is the breakout off of the termination. The magenta line is exactly where the highest concentration of sellers were. And when the market comes back and taps that line, next-gen users have the opportunity to enter and to carry that market down off of that key area. The green lines are from a low. So a zone holds on the low, the small triggers roll, and when the market pulls back to them, that becomes your opportunity to take that trade north. So guys, the high volume area trade is your, let me take advantage of understanding where the market can turn, let the small chart show me change, and let me enter at a very clearly defined area to look for that trade. After the high volume area trade, your next trade is the trend trade. You've already come off of that top or bottom, the trend has changed, and now you're just looking for continuation with it. So this trade is dependent on not trading into areas, not trading into zones on the 15 and 1 minute charts, making sure that your path is clear, that you have room to take profits. And then all it is when the market is going down and there's nothing in the way on your large chart, the 15-minute, and the market is going down and there's nothing in the way on the 1 minute. So both charts tell you we're going down, there's nothing in the way. Very often the market pulls back right to that mid-band. If that mid-band happens to be at zones, 1-to-1s, HVA lines, even better. But when the market pulls back to this mid-band behaves as an awesome continuation point to continue with that trend that's already established. But these fast triggers, guys, can ruin your party. These fast triggers can ruin your good time. So the rules say buy or sell a close on the correct side of the small triggers. And the correct side of the small triggers means below them for a short trade or above them for a long trade. It means that you're no longer fighting that fast moving average, and the close on the correct side gets you into the trend trade and then hopefully gives you all the continuation down. So that's the second trade. And if I go back to that picture that I showed just a minute ago, first we reach an area. First opportunity comes from the HVA. Second opportunity comes in the form of a trend trade. And that's kind of the second trade that you're going to see. So I've got a couple examples. Everything says up. The market pulls back to the mid-band. And you'll notice that I don't get a close on the correct side of the triggers until right here. So your 1 minute chart is going to create a lot of patience. You take the entry, and sure enough, the trend trade goes. Close on the correct side of the triggers on the mid-band. And then I believe I have another long trade. Everything says up, pulls right back to the mid-band, closes on the correct side of the triggers, and sure enough, the market continues up. So that's your second trade, and that's going to be capitalizing on the continuation. of a trend. Very often, the market will be moving with ferocity. There will be momentum on both charts. And if there's nothing in the way, it creates an opportunity on that 1 minute chart to just capitalize on momentum. So if the 15-minute chart doesn't have anything in the way, and both charts have strong triggers, and strong triggers is defined as just a separation between the small and the large. So in an uptrend, when the smalls are up and above the large triggers, when there's space between, that's your strong triggers. That's your momentum look. In a downtrend, it's going to look like this. We're going to buy or sell pullbacks, but these are quicker pullbacks. So when the large chart has momentum and it's trading above trouble, and the small chart has momentum, very often the market's going to come up and snap back. And when it does, you're going to capitalize. So the market has momentum on both charts. It comes through, pulls back. You can enter right at these 1-to-1s. It's a very low risk trade very often. And what you're anticipating is that with a solid foundation to bounce from, the market continues up. These momentum trades are outstanding. You can take them from 1-to-1s. You can take them from mid bands. You can take them from those zones. But all it is you saying, with all of this strength, it's probably not going to be able to pull back all the way to the mid band. I'm going to take an opportunity right off of this area. And if this trade fails and it does go down, very often the trend trade becomes the next trade. This is a way to capitalize on the immediate strength. Strong triggers down, the market breaks through the zone, pulls back and retests it. This is your momentum trade short using a zone. Market is strong, breaks through the mid band, pulls right back to the mid band, happens to be an HVA line, bonus, and sure enough, the momentum continues down. And hitting that next area is an outstanding place to take profits. And when that momentum trade fails, it turns into a trend trade and continues to move to the next zone. So the trades are really kind of a time tested. NextGen has been teaching people to trade for the last 30 years almost. And the concepts are the same, and the minute bars are the same thing that NextGen taught 20 years ago. They just look a little different for some people that aren't accustomed to the indicators. Where did it go? One of the things that I've put together for you guys as well is a little spreadsheet. And the spreadsheet is a great place for you to go back and take pictures. And when you simulate, there's a trade tracking sheet for you to track exactly what you're going through, what it is, how you did. And then you can drop those in the room and get some feedback on everything that you're doing. But guys, these are the trade looks. This is the high volume area trade, the trend trade, the momentum trade. I'm beginning to create this idea of how you can manage these trades, reasons not to go long or short. And you'll notice that the trend trade tends to be the most common trade that I'm finding great pictures of. So as you begin to study this plan a little bit and you try to put it into practice, you do have a little cheat sheet to go off of to look at. So can you get this Excel sheet? Man, Jerry, you already owe me a steak and a ride in a plane. How in debt do you want to get? Just kidding. There you go. Dropped it in the chat box. And then, guys, of course, if you come to NextGen later in life and you need a copy of this, all you have to do is reach out. I've got it. I just whined plenty. So let's get into TradingView a little bit. Now that we've gone through, hey, these are the indicators, these are the opportunities, let's take a look at just some of the basic functionality, guys. And one of the things that you can do is you can move this chart all around. So if you just click on, you can move it close, you can move it far, you can move it up, you can move it down. The price bars will stretch things out, bring it tighter. The time bars will give you a little space between bars. So make it so that it's comfortable for you. And same as on both charts, go through, take a look. That's going to be your scaling. One of the things that you can do, guys, is as you get into the market and you want to trade the market, I think the easiest way to do it is just, oops, I need to get to paper trading so that I'm on simulator. you can just mash a sell button. Boom. And now you're in a short position. The opposite of sell is buy. If I click buy, I'm out of my short position. You can see that my chart tells me where I got in and where I got out. This is a great opportunity for study. You can make that happen by clicking the settings wheel down here. Go to more settings. And when you're talking about trading, guys, you can do executions and execution labels. So if you don't want to read the prices, taking labels off will still give you arrows. I like the prices because I like to do the math to see where I'm at in the particular trade. That is one way of entering. Simply buy or sell. It'll put you in at the most current price. Once you're in a trade, let's say hypothetically I'm in a long trade, and I'm going to slide price over here so that we can see it clearly. I can put my profit target by clicking TP. Maybe I want to get out at a zone. I can put my stop loss maybe below the reversal bar that gets me in. So I can see the risk that I have in the trade. I can see where I'm at in this particular trade. And I also have a clear vision of where I'm hoping to get out. They'll show up over here as well. Very often when the rules are met, and I'm not saying that the rules are met on this one, you might say, well, that 15 minutes says I'm going for a bigger trade. And you can pull things out to areas here. Or you may say, I'm more interested in just taking smaller, quicker profits using small chart advantages. And I'll get out before trouble on a small chart. And then again, if you need to exit the trade, the opposite of buy is sell. You can just stomp it, or you can click the X. Some of you like predetermined stops and targets. I personally have found that moving those two is fast enough in the right trades, but you can click the trade panel, and before you ever enter, whether it's going to be a long or a short, a buy or a sell, you can input your profits, you can input your stops, and what this does is if you choose to enter this trade, you know exactly where your stops and targets are going to start off. So if I hit sell, I'm in. Whoops, that was... If I hit sell here, excuse me, I'm in the market. My stop is already in place, as is my target. So I'm in a good position, and there I am. And then if I want to exit, I simply X out. I think this is a little cumbersome personally. That's just me. I would rather just take a short trade like this, drag my stop loss, drag my profit target, and go that direction. You'll figure out what works best for you. And then finally, there's this really cool thing that you can do with replay trading. So as you go through and study these, replay trading gives you the ability to work backwards, to trade a market that's already done trading for the day, to practice entries, to practice management, to practice getting comfortable with the functions of TradingView. And there's a couple ways to make it easier on you. So under replay, there is a drop-down menu. You could do a single chart, but guys, we trade two charts, and the rules reference both charts. So make sure that this says all charts. When you click replay trading, it's going to ask you to launch bar replay. Once I click this button, it's going to give me a blue dot next to replay trading. And if I collapse the panel, now I'm in, and you can see that I've got stop, fast forward, super fast forward to the real-time chart, how fast I want to go and what time frame I'm on, the replay interval, and it's on 1 minute. Select the date. So when I click select the date, today is Monday. Obviously, I can't replay in the middle of a live day. I'm going to go back to Friday the 13th. And if I click Friday the 13th and select, it's going to pull me back to Friday the 13th. And guys, Friday the 13th isn't trading where it was trading live. So I have to right click and reset my chart view, and right click and reset my chart view. And then from there, I'll do what I need to do to feel comfortable with the look. Maybe you need to stretch it out a little bit, bring it up, give it some room in between, just whatever makes you happy. Now if I click that bar, this market's going to start moving, and it's a little quicker than normal because it's a 1 minute interval. So you'll see the 1 minute, price reaches a mid band, but no rules are met for a long trade. And you can go through and you could sell the market the same way we sell it if it were live. You can flatten your position, you can take profits, you can move stops, you can move targets, all of those things. So replay is an outstanding way to go back and get more repetitions. And then if you want to close out, just hit the X, exit bar replay, absolutely. And back to the live market you go. So those are kind of the functions, guys. That is how to scale, how to do replay, how to enter, how to move stops. That is an introduction to the indicators. That is an introduction to the trade plan, and a great spreadsheet to go through and do it. So from here, it's going to be all about repetition. It's going to be all about what you're seeing, what you're doing. So I'm going to click on Bob's. Bob says, here's my trading view charts all set up. And Bob, you've got it, right? You're looking at crude oil. The market is traded into a termination condition when the small triggers roll. There's your HVA trade, Bob. Right there. Absolutely perfect. And it looks like you're good to go, man. Because this is 0.01, it tells me that you're not either in paper trading or an account, and it's not going to allow you to trade it yet. So you'd want to click on your trading panel, and let me show you exactly what that looks like in a real world. You're going to want to click on your trading panel and make sure that you're in paper trading or associated with an account. Good stuff, man. And what you guys will find is that if you are one of my next gen users, it's going to take you just a little bit because you're accustomed to Renko bars. You're accustomed to what you're accustomed to seeing. The methodology is very, very much the same. It is momentum and path. When everything says down, looking for a trend trade, looking for an HVA, looking for a little bit of momentum. Miss Claire. Zone reached on the 15-minute chart. 1-minute chart triggers roll, sell the HVA. And down it went. Nice job, Claire. That's an HVA trade. And you met all your rules, and sure enough, it went down. Did the first one give you an HVA? It doesn't look like it did. So not an HVA trade here, but there's that high volume area. It pulled right back to it and continued down. Great look, Miss Claire. And then as we come through here, let's see what we have. So there's your termination. There's your HVA line, but they didn't come back and get you. So while the read was beautiful, it doesn't look like it gave you an entry. And then when everything is continuing up, you're above the zone. So Claire, one of the differences between what you're accustomed to and what we're doing is when price is above these zones, that zone's in the rear view mirror. The trigger lines are going to be used to define direction and momentum. The trigger lines are not used to define termination conditions on the large chart. You're going to let price be above or below these areas. So you're absolutely right. You're above everything. Pulls back to a zone. There's a great second chance to take the long. And then you choose not to take the HVA here. Let's see. Because I think they hadn't reached the area yet. The small triggers hadn't rolled yet. And it goes right to the zone, and you're not taking a momentum trade here because you have no room to trouble. Did I read that right, Claire? Nicely done. So just going through the little things. Let me grab charts. Let me annotate charts. Let me post them in the room. And if you're new to NextGen, guys, this is what we've been doing for as long as I can remember. Is you show me what you think. You show me what you see. We talk about it. And if there's anything we can do to make it a little better, we make it a little better. Outstanding, Claire. This one's a little harder to read. So this was the S&P. And did this just happen, Claire? One of the things that makes my job easier is if you make it a little easier for me to read. Give me a little space there. So let me see where you're talking about. The HVA right at 11 a.m. So let's go through the whole process. At 11 a.m., you're talking about this pullback to the HVA. So what do we have? Um, we have a large chart that had divergence. The fast triggers are down, but the large triggers are still up. So we're not playing with momentum yet. We don't technically have a termination condition. So the HVA trade may not be in play. The first rule isn't met. And this 1 minute zone is all the way across. So the momentum trade into it failed. The momentum trade into it failed. The momentum trade into it failed. So there's no momentum trades because we're not trading from it, we're trading to it. So it pulls back up to an HVA. Your fast triggers are up. Claire, this is one of those times where it looks like there was a lot of movement, but I can't find my rules met. I can't find the rules met for an HVA trade. I can't find the rules met for a momentum trade. I'm nowhere near a mid band, so I can't even find the rules for a trend trade. Does that make sense? So if you're brand new, you're like, dang it, I don't have any rules met here. But Claire, let's talk about how people grow with indicators. There may become a time where you say, well, my fast triggers are down and I have room to get to the area and my smalls are below the large and there's an HVA, and you know what? This HVA says to me, this is the exact spot where all the sellers got together to say they wanted it to go down. And you can see that it tests it twice. And Claire, you might create an opportunity in there somewhere with all the triggers below it, with this saying down. Maybe you sell it. I don't have a trade for it. So I like that you said, what I see, help. You're saying it's weak. You see the HVA. You're saying there's not room to the termination. And then that's super squished. So let's go see what that did over here. So over here, the zone breaks and they retest it. Close below the triggers. I think you pointed that out. I love it. Zone breaks, gets retested, close below the fast. Easy way to go down. Directly into one-to-ones, no reason to go short. Pulls back to the mid band with this saying down. You do get closes, but there's that HVA again going with the trigger lines, Claire. So short trades, less likely to work, trading directly into something where the buyer said, hey, this is where we want to go up. I think it was a great chart read. And I think that you couldn't find rules met. And we're just being patient. We're waiting for it to all be good. Nicely done. One of the pictures that I took, and this is probably going to be good for you guys as you learn it. Let me see where I put it. You start to recognize these things. When the small triggers roll against you guys, very often it goes and tests the higher areas. These 1 minute triggers really show it. 15-minute triggers. I think this is the picture that I had. Okay. So Claire, if we go back to the idea of letting the large chart define the momentum and the direction, when the smalls are outside of the large, these are your easiest long trades, guys. This is when it's the absolute easiest to hold for the big ones to go. Once the smalls work inside of the large, if you take long trades, you really need to manage them. And then once you get to the other side of the triggers, this is where shorts become easier. And Claire, the one thing that you noticed, and the one thing that you typed on your chart, is you noticed that you were weakening and you were on the short side of the triggers, which lends a little bit to those HVAs. And then when you come back inside, you have to manage. And then when you get to the other side, anything you do, you have to manage. So there's an easy look, there's a managed look, there's a harder look. So right now, we're in the managed look, and the small chart said up with strength, pulled back to the zone, made it right to trouble. and we're going down. You'll start annotating the next trades. And guys, it just takes a little time. It's all chart reading. So Bob at 11:42. So I can't see your large chart. I don't know what your large chart's doing. You forgot to catch it up to the party here. But let's just look at this. You have odds favorable momentum, and you get in at 76. So you're trading directly into a zone. But because of the momentum, you take it and you ride it right up to the outer band, which is a great place. Nope, you got out at 88. So from 76 to 88. And a little bit of the wise would help, right? I love it. But you got in, you got out. Practice entering, exiting, doing all that stuff. Bob, one thing I'm going to ask is why do you have 15 indicators on your 1 minute chart? Yeah, but so Bob says $120, but Mark, it was $120 practice. Can you repeat it? Does it win more than it loses, right? So $120 is great. It's great. But it needs to be repeatable. I can't see anything on your large chart, right? You're trading directly into a zone on the small chart. And instead of getting out of the outer band, you held it all the way back to 88. So one of the things that I encourage you guys to do is don't focus on the money. Bob, you used to do that trading into termination conditions. You used to love to tell me how you made $1,000 trading into termination conditions. And when you went live, every one of those damn termination conditions held, didn't they? So creating repeatability, guys, creating repeatability, that's what annotation does for you. And as you go through the transition and you start using TradingView, or you're coming over and you start trading this plan on TradingView, I'm going to encourage you guys, drop your pictures in the room. Tell me what you saw. Tell me what you're doing. And it all comes together. So feedback, feedback, feedback. I'm going to end this particular video, guys. I'm going to kill that one.